So many of us today kind of look like this when we get our paychecks. Money comes into the checking account, and then a lot of it leaves our checking account every month to pay some type of interest payment or some type of tax payment. And Sheena, when people want to save more money, is there any doubt in your mind what piece of the pie they got to minimize so they can increase savings? They got to reduce lifestyle, don't they? They got to cut up their credit cards, tighten their belts, and have no more fun. Now, it isn't that process can't be accomplished. It's just for most of us, it's just too hard. Our process is easier because we're going to reduce the outflow of money. And what you're going to see here in a few moments is by reducing this outflow, we actually add dollars to the other two pieces of the pie. You see, your financial advisor, if we look at the plan that they've put in place for you, it's an accumulation of money plan over a long period of time, at least 20 years. And if you remember the rate of return that they told you that your money was going to accumulate at, did they tell you it was guaranteed, or did they tell you the rate was historical? What's my point? As we go along with this education, what I want you to think about is, do you prefer the financial situation you're sitting in today, or would you trade it all to be absolutely debt-free, including no mortgage? Now, I'm going to show you examples of a few clients. And what I want you to focus on is I want you to focus on the benefits that our process gives every one of these families. Our process works for all debt and all income levels. So here's our first client, Mark and Joyce. They're in their mid-30s. They're making $7,000 a month, and they have minor children. Like a lot of younger people, they're starting off in their savings journey. They don't have a lot of money. And of course, they have more debt. They have more debt than assets. Okay. And in this case, this family just has 180 of debt. If they could write a check today, they'd be debt-free. But you already know people can't do that. They have to pay their debt off over time. And because they're paying their debt off over time, they're going to send a lot more interest back to the lender above what they borrowed, and it's going to be a lot more money. 30 years from now, if Mark and Joyce decide to keep doing things their way, 30 years from now, they're going to be debt-free, including no mortgage, 100% equity in other assets, and they're going to have money in their 401k. Or look at this, paying off their debt our way, they're debt-free in less than 8 years. They've saved a lot of interest. This money, this $2,177, this money used to leave their household or their checking account every month to pay the debt. Now that they're debt-free, this family can do anything they want with their money. They could spend it, they could buy more stuff, or they could simply save the money with no risk. We're not against investing, but this process has nothing to do with investing. And look at this client. By simply saving this money, look what they've accumulated over that same period of time. Now, how did we do it? Well, remember the side-by-side report I shared with you that every person has an opportunity to receive, showing you in advance how our debt payoff process compares to yours? Well, I'm going to review a few debt payoff reports, okay? And remember, in order to get the report, we need the financial information, we need the debt numbers, and we need to know where you're keeping money. And Mark and Joyce have provided me with that data. So now what you're going to see this report verify is why our clients are choosing to add an additional financial institutions contract to their debt payoff process. So not only are you going to see our clients becoming debt-free 2 to 3 times faster than their plan, you're going to see all the more money and benefits that they also get as a result. Now let's take a look at why our clients are adding a permanent life insurance contract to their payoff process. Let's also take a look at why this has nothing to do with life insurance in its traditional sense. The client gave us their data, and what we identified is they have $625 a month that they can run through this new contract. Where did we find the money? We found the money for this client in 2 places. First place, you don't make extra payments towards your debt in our process. You will continue to make the minimum required. Any extra money that you've been paying towards your debt will first go to the insurance contract. So we found $325 of overpayment of debt. Where did we find the other 300? Well, I'm sure you've heard of people having 6 months of their earnings safely tucked away in a safe account in case something bad happened to their career. They've got money to live on. Well, this family was saving $300 a month. So what you're going to see is we've showed them how to redirect that 300 to pay their debt off faster, but also have liquidity if they need it. Our report shows our clients their way of paying off debt, our way of paying off debt, and the interest they've saved. Shows you right up front. This is all certain. Okay. It doesn't work by magic. You follow the steps, you will be debt-free when your report says you will be. Okay. Question everybody has is, how do I know when I'm going to be able to pay off my debt? Well, our report provides you with the time frame. There's no guessing here. So when you get your report, if you follow through with this program, you're just going to take out your calendar that we all have on our phones. And here's what you know. Your first debt's going to be paid off in less than 2 months of starting, 5 months, 9 months, a year and 2, and a year and a half. And you get me, if you were this client, you'd know when these debts were going to be paid. Let me fill in some gaps for you. This is an insurance contract. You'll need to qualify for it health-wise. But this is not an insurance contract where we want to put in place the maximum amount of insurance that you can get, because that's not the purpose of this contract. Okay? The purpose of this contract is to have a superior account over your bank to run money through, to pay your debt off 2 to 3 times faster, with more benefits and money at the end of the day. Within married couple families, sometimes the spouse who makes all the money isn't the best spouse to put the life insurance contract on, because maybe they're not as healthy as the other spouse. So we'll put the contract on their life, because this is about paying off debt. This isn't about death benefit for surviving family members. Okay, that's traditional insurance. This isn't. Life insurance contract gets put in place. Remember the 625 that I spoke to you about? That's the amount of money Mark and Joyce are going to send to the insurance company every single month. Now, as soon as there's enough money in the insurance contract to pay off the first debt, what our clients are going to do is they're going to use a really cool provision that this permanent insurance contract has. And it's a provision to keep your money in your contract earning benefits and use it as collateral for the insurance company to send you their money. So we're going to do what affluent people do and use other people's money, which is the insurance company's money, to pay off our debt while our dollars are in our insurance contract earning benefits. And it's a simple form we send to the insurance company telling them to send us our money, and they're going to direct deposit it right into our checking account. What our clients do is they lump sum pay the first debt with that money. Lump sum pay it. When the debt is gone, you see the $55, Sheena, that used to leave this client's house, this client's checking account, used to leave every month to go pay the debt. That was the minimum payment. Now that this debt is no longer here, where do you think we want our clients to put the $55 now? We want them to send it to their new insurance contract to fill it back up. So rather than keeping that 55 in the checking account, all we want our clients to do is send it to the insurance policy. And Sheena, we're going to continue to do that until they're debt-free. So in month 5, we're going to take the policy loan. The company's going to send the money back to the client. Client takes the money, pays off this next debt. What do they do with the $200 that used to go to the medical bills financial institution? That's right, Mike. You send it back to your insurance contract. And you'll keep doing that until you're debt-free. Now look at this. In a year and a half, this family has freed up $1,200 of financial obligation. Imagine if this family did this planning back in late 2018, early 2019, and then a year and a half later, that COVID pandemic hit and there was a shutdown. How much better does this family feel having $1,200 less in financial obligation during those tough times? Okay. I think they feel a lot better than investing that money in a Roth, a regular IRA, a 401k, real estate, or buying crypto. I believe they've got more financial freedom, don't you? One more thing. You know, when you go to the bank and you open up your checking and savings account contracts, you know the person helping you do that? Do you ever ask that person that's helping you at the bank? Do you ever ask what's in it for them in the bank for you doing your banking business? Do you ever ask them that question?
Mm-mm.
No, because you know the bank's paying that person, don't you? You see, in my process, my clients don't pay me an additional fee to do this. The financial institution we're working with, the insurance company, they pay me to set up these accounts, just like the bank pays the bank employee to set up your checking and savings accounts. So look at this. This is our ledger showing you all the detail. And this is easy to understand. I'm going to explain it to you. Well, this is the insurance illustration for this couple. When you get your report, these will be your numbers. The middle shows you the payoff. Taking money out of your insurance contract. CV stands for cash value. This is taking the money out of your cash value in your contract. And you see these acronym, end of year. This is you sending the money back to the insurance company. Remember the 55, then the 255. Remember that? The reason the numbers are going lower is because you're freeing up the money again to be used. You with me? Over here is showing you your liquidity as you're paying off your debt. Okay. What's really cool, see this E and E? It's called emergency and emotional cash value. We build in liquidity into our clients' debt payoff process. And what's fantastic is we only show our clients paying off their debt using 85% of the money available. We keep 15% of the money in reserve just in case our clients have to stop their debt payoff journey because they need money for a more pressing reason. This contract that's not the insurance policy, it just needs to pay you a 2% rate of return. And we can get 2% every day. This is not investing. Okay. And of course, this outside column is showing you your liquidity as you're paying off all your debt. Now, everybody asks me this question. Now that I'm debt free, do I have to keep doing this plan? And the answer is no. And if this family decide to cancel, they're debt free, they owe nobody a dime, we'd give them a 5-figure check and they're done. So the first benefit of our process is debt free faster than our client's process. The next benefit, bad things happen to good people all the time. Longevity is not guaranteed for any of us. Facts are roughly 1 out of 4 people born in this country do not live past the age of 65. And if something bad should happen early, look at this. We've got enough money for this family to self-complete their debt payoff process. There's enough money here to leave the family debt-free. Now, it's not enough life insurance to take care of the family, but I want you to know that's not why we're here. We're here for debt elimination. The next benefit, this is a little bit of humor with seriousness. Many of us don't die the first time we try. We can be kept alive, but being kept alive means we need care. We need help getting fed, bathed, using the toilet, getting dressed. And in our industry and in the medical industry, what I was just talking about are called activities of daily living. And when we lose the ability to do those, many of us understand we need help. We need to get care. And if we need help doing those activities, what's cool about this contract is that it will pay out roughly 1/4 of this money for 4 years. So almost all of it income tax free, to help cover costs associated with losing the ability to do 2 of those 6 ADLs. So as you can see, by simply adding this additional contract to your debt payoff process, not only are you paying your debt off 2 to 3 times faster, but look at the additional benefits you're also receiving by doing this as well. Well, sometimes when they see all these benefits, there's a little thing inside their head that says, this looks too good to be true. Are you feeling that way at all?
Oh, no.
Well, some people are. And I like to remind anybody that's feeling that way that this process isn't too good to be true. The reality is, if you follow the steps that we put down in your report, you'll be debt-free exactly when your report says. In other words, what I just told you is you have to put the money in. You've got to redirect and follow the steps to make this work. It doesn't work without you. Let me show you a couple of more items, a couple more clients. Here's a 61-year-old couple. Here's their debt, 24 years, their way. We found $700 a month. Look at this. 9.3 years. How much better does somebody's retirement lifestyle, how much better is it when they hit age 70, they have no debt, and all of their Social Security income, along with money that they supplement from their savings, can be spent on their needs and wants and not on debt service? Isn't that fantastic? Look at this one. This is a high income earner. Either she happens to be a professional physician as well as a business owner. Look at all these the mortgage debt she has, just under $900,000. If she was making the regular payments, she'd be debt free in 23 years. What we learned from her when we got to know her is that she was overpaying all of her mortgages by $5,000 a month. She's making $750 a year. She can overpay the mortgage total by $60,000 annually. Why is she overpaying the mortgage debt? For one reason, she wants to be debt free faster. We ran another calculation, and her pay the lender directly process of $60,000 a year, she'd be debt free in 8.7 years, continuing her way. If she uses our process, she's debt free just a couple months later. So her way of paying the lender extra money, she's debt free in 8.7. Our way is 8.9. Why did she choose to work with us? Well, here's why. Because with her pay the lender directly, she didn't have $2.4 million of self-completion money. With her pay the lender directly, she didn't have $250,000 a year times 4 years. So roughly $1 million of benefits to help cover care costs if she needed it. With her pay the lender directly, she gave up her liquidity. Because if she ever got into a bad way financially, I think she can't call the lender and say, give me back the extra payments because I need them. That money's not hers. It's the lender's. And if she's in a bad way financially, she can't qualify to get an equity out of the buildings, can she? Mm-hmm. What she also appreciates is if she's ever litigated against and loses, all of this money is judgment proof. If she doesn't want to do this planning anymore, she cancels the contract. We'll give her a 6-figure check and she's done. Or look at this, Sheena. Or she can put all the money back in the contract, repay the policy loan. At age 55, we have her stopping the premium, and look what she has. She's debt-free. She's got $1 million war chest to do anything she wants, and $2.6 million of paid-up financial death benefit. How's that?
That's awesome.
So, would you like to see your report?